Hey everyone, in this video I'm going to give you 3 reasons to buy Tesla stock and 1 reason not to. So let's begin with the first reason to buy Tesla stock. Absolutely phenomenal revenue growth. Look at this chart dating back to 2013. Tesla's revenue has grown from less than $1 billion all the way up to $24.32 billion, with much of that growth coming after 2020, Tesla really ramping up production capacity and ramping up sales at the same time. So it's been able to just ramp up production and sustain consumer demand enough to meet that production, right? So it hasn't just produced and kept the supplies, it's been producing and selling at the same time, resulting in these excellent revenue growth rates. And management has told investors that Tesla expects to increase production and deliveries at a roughly 50% compound annual growth rate for the longer term, which would be excellent growth rates if the company actually achieves that over the next several years and the longer term. The second reason to buy Tesla stock is that it's reaching economies in scale as it's ramping up production. What I have here is Tesla's operating profit margin over the trailing 12 months, and you see from 2014 all the way up to its most recent update, Tesla has expanded its operating profit margin from the negatives in negative near 24% all the way up to 16.98%. Now, this is something I look for in a growth stock, especially, is increasing profit margins with increasing revenue. Tesla has demonstrated excellent revenue growth, like I showed in the first reason to buy Tesla stock. But in the second reason to buy Tesla stock, Tesla's actually using that growth in sales to expand its profit margin. This is not very common among companies that are growing as fast as Tesla is growing. Many growth stocks like Tesla find it difficult to expand profit margins while growing, right? Because their focus is so much on just ramping up production, ramping up sales, that they're not paying so much attention to controlling costs, to economies of scale, and managing effectively. Tesla, on the other hand, is doing that. They are controlling costs, they are increasing profit margins, while at the same time increasing sales. So that's why this is the second reason to buy Tesla stock. The third reason to buy Tesla stock is because you haven't had an opportunity to buy Tesla stock as cheap of a valuation as you have right now using the forward price to earnings ratio. Looking at this metric, Tesla is trading at a forward price to earnings of 33.4, which is near the lowest it has been going back to January of 2022. And the price to earnings ratio of 33 is relatively inexpensive for a company like Tesla that has been growing its revenue and earnings at the rate that it has been growing it, right? So when you have a company that's growing earnings per share as quickly as Tesla is, typically the valuation is higher because investors are willing to pay a premium price for a company that demonstrates this level of earnings growth, because they think about it this way. Look, I'm buying a company that might be earning, let's say earnings per share, for example, is $5 this year, but they're growing earnings so fast that if I buy the stock today, in 3 years, that earnings per share might be $10, from 5 to 10, and then 3 years after that it might be $20. So I might be paying a price to earnings of 10 right now, but if I wait 3 years, I will have looked like I bought the stock at a bargain because it increased earnings per share so quickly that it looks like I paid a bargain price for it in terms of price to earnings. And that's the opportunity that Tesla presents investors today at this forward price to earnings ratio of 33.4, looking 1 year ahead. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. All right, so that's all the good news. Now let's look at one reason why investors should not buy Tesla stock or should avoid Tesla stock, and that is competition. Competition. For the most part of these last 10 years, Tesla has had relatively limited competition in terms of selling electric vehicles. There has been some competition. Of course, it's not been the only EV car maker out there, but competition has been nowhere near the degree that it's been in the last year or 2 or 3 years. Several car companies have entered into the electric vehicle industry, and then legacy car makers have increased their plans to produce electric vehicles significantly, right? And so all of that together is leading to a massive increase in competition. And one way that's going to show up is in Tesla's gross profit margin. So here I have several car makers: Ford, Mercedes, Rivian, BYD, NIO, Lucid, General Motors, Honda, etc. And I have here their gross profit margins to the right. The you don't need to look at all of them, but what I wanted to highlight is Tesla's gross profit margin at 25.6% is the highest among all of these car makers, and by a considerable margin. The only one that's close is Mercedes at 22.69% and Honda at 19.98%. Everyone else is in the mid double digits, or negative or lower. So Tesla is really unique in this gross profit margin, and that's namely been because they've been so good at ramping up production effectively and efficiently. But now that they've got so much competition, that's going to be harder to do on two fronts. On two fronts. And let me talk about each one in detail here. The first is on the supply side. So for Tesla to produce as many vehicles as it wants to produce now, it's going to be more expensive, because to secure the materials and parts that it needs, it's going to have to pay higher prices, because now Tesla's not the only one in the market buying those materials. Now Tesla has to compete with all of these other companies looking to buy those same materials to produce electric vehicles at a similar degree, right? They're all ramping up production, trying to produce in significant amounts, right? Not just 5 and 10,000 units anymore. They're really trying to ramp up to the hundreds of thousands of units now, and trying to scale up. So they're all buying up these materials, increasing the cost of goods sold, and that's going to pressure Tesla's profit margin. And management has already said that that's going to bring Tesla's gross profit margin down. The second point, the second point where Tesla's gross profit margin will decrease because of competition is on the price side, on the demand side. Consumers now have a multitude of choices when they're going out to buy an electric vehicle. So some of those consumers are going to choose another car simply because it looks better, or they have the color that they want, or for whatever reason why it might be the case. Even though Tesla might have the better car at the same price, maybe better performance, consumer might still choose another one, right? That's just consumers. Their taste might, they might want something different. The other reason is price competition. You've seen now in the first part of 2023, several of these car companies introduce significant price cuts. They're lowering their prices. And so if they're lowering their prices, now consumers have another reason to go with a competitor instead of Tesla, right? Now it's not just that they maybe like the color or they like the style, but now that car might also be less expensive, or close to being less expensive than a Tesla. So Tesla's increasing competitive forces make it one reason to not buy Tesla stock. And it's a strong reason not to buy Tesla stock. I'm pointing to the gross profit margins here at 25.6%. Tesla's management in its most recent conference call alluded to the reality that Tesla's gross profit margin might fall into the teens in 2023. Into the teens. So that means 19% at its best for 2023. Now, they haven't gone out and officially said that's going to be the case, but given the pressures they faced, and this was around December of 2022 when management gave this highlight. Now, April of 2023, competition, the forces of competition have only increased since then. So I suspect that when management comes out to discuss their gross profit margins and reveal their latest gross profit margins, I suspect it'll be closer to 20% than 25% in the first quarter, and I suspect a downward rate of gross profit margin for the rest of 2023. Now, Tesla stock investors can hope that Tesla will make up the lower gross profit margin by selling more units, by selling more at lower profits. That could help. That could help. And so that's something to also keep in mind. But certainly, competition is never a good thing for investors in an industry, and certainly not when competition is as fierce as it is in the electric car market, right? The only other industry that I think is worse in terms of competitive pressure than the electric vehicle industry is the food delivery industry with Uber and DoorDash and those. If you look at competition there, it's much worse than it is in the electric vehicle industry. But if this persists, if this degree of competition in electric vehicles persists, it could get to that level because I've only seen competition and fierceness just continue to grow and grow and grow and grow between these car makers. So it's not like competition is high but stable. Competition is high and increasing in the electric vehicle market. All right, so there you have it. 3 reasons to buy Tesla stock and 1 reason to avoid Tesla stock for investors that are interested in this electric car maker. All right, so that's all I've got for this video. Thank you so much for watching. I've picked some videos I think you'll enjoy, so they're popping up on your screen. Please click one of those and I'll see you there.